For the better part of a decade, private credit has been, well, the darling of the alternative investment world. But the foundational beliefs that built this multi-trillion-dollar asset class, they're now facing a serious reality check. Okay, let's dive into this and see what's really going on under the hood. You've heard the pitch, right? This was the promise, the siren song that pulled in a massive wave of capital. The idea was so simple, so perfect. You could get these high returns you'd normally expect from, say, an equity investment, but with the supposed safety and priority of a loan. I mean, who wouldn't want that? It seemed like the perfect deal. And look, for years, with cheap money and a booming economy, this model looked foolproof. But that era is over. It's gone. Now, with higher interest rates and a whole lot of economic uncertainty, the very ground that private credit was built on is starting to shake. We're about to find out which of those bedrock assumptions were solid and which might have been built on sand. So, to get to the bottom of this, here's our game plan. We'll start with the initial promise. Then, we're going to deconstruct the key myths versus what's actually happening today. We'll look at some real-world examples, lay out a new playbook for due diligence, and finally, take a peek at the future of credit. So, let's start with that promise. You see, the incredible success of private credit was built on a set of core beliefs. These fundamental assumptions about how risk, return, and maybe most importantly, recovery from a bad loan would play out. Investors, well, they bought into these ideas wholesale. And that brings us to the real heart of the matter. Which of those foundational beliefs were just myths, and what is the new market reality? We're going to peel back the layers of that typical pitch deck and really challenge the key assumptions that have held up this market for so long.
First up, the illiquidity premium. The story was, hey, you get paid a nice little bonus, a few extra percentage points, just for locking up your money for a while. But the reality? It's a lot harsher. When a company gets into trouble, that same illiquidity becomes a risk multiplier. See, in public markets, you can dump a bad bond. Here, you are married to that deteriorating asset, for better or, increasingly, for worse.
Okay, next up is the myth of low defaults. The numbers on paper, they look fantastic, right? But the reality can be a mirage. Instead of actually declaring a default when a company is in trouble, managers often use these amend and extend strategies behind closed doors. They're not solving the problem, they're just kicking the can down the road. And one of the main tools they use for this is the PIKE, or payment in kind toggle. Just think of it this way. A borrower can't afford their interest payment in cash, so the lender says, no problem, just add that interest you owe me to the total loan amount. So on paper, no default. But in reality, the company's debt just got bigger, and the underlying business problem is still there, festering. Then there's the big promise of superior covenant protection. Covenants, they're supposed to be these tripwires that let a lender step in at the first sign of trouble. But as tons of money flooded the market, competition forced lenders to offer covenant-light deals, loans with way fewer restrictions and, honestly, some crazy loose definitions of profit. This means that by the time a covenant is actually tripped, the company might already be on life support. Okay, let's talk floating rates. This was a huge selling point. As central banks raise rates, your returns go up. Simple. But this is a classic double-edged sword. Yeah, the lender's yield goes up, but at a certain point, the borrower's interest payments become so high, they drain every last drop of available cash. The very thing that was meant to protect the lender becomes the thing that pushes the company off a cliff. And what about the deep-pocketed private equity sponsor who owns the company? Surely they'll step in to save their investment, right? That's the assumption. The reality? It's a cold-blooded calculation. A PE sponsor's first duty is to their own investors. If putting more money into a failing company is a bad investment, they're going to cut their losses and walk away, leaving the lenders to clean up the mess. And finally, the ultimate safety net, being a senior secured lender. It's supposed to mean you're first in line to get paid, no matter what. But here's the catch. Being first in line only matters if there's any value left to claim. If the company's total worth has collapsed, being first in line to get a piece of a worthless pie means you still get nothing. So let's see how these broken assumptions actually play out in the real world. I want to walk you through two quick scenarios that show how these seemingly safe loans can turn into major problems. So take this first case. A company's struggling with its interest payments. To avoid a default on the books, the manager agrees to one of those PIK toggles. Now, the loan is still marked as performing, everything looks fine, but the debt has secretly ballooned to $115 million. The manager has avoided a short-term headache, but the investor's chance of getting all their money back just got a whole lot worse. In our second case, a lender felt totally safe with a 5x leverage covenant. But the definition of profit, that EBITDA number, it was so full of optimistic add-backs and adjustments that the real cash leverage was a staggering 8x. By the time the alarm bell officially rang, the house was already on fire. That protection was just an illusion. So, given all these risks, how should you adapt? This brings us to a new framework for due diligence. It's really about moving beyond the glossy track record and starting to ask much tougher, much more pointed questions. You've got to start asking these things. How much of that return is actual cash in the door versus just an IOU? Are the covenants tested every quarter, giving you an early warning, or are they the weaker kind? Is the valuation based on a realistic fire sale scenario, not some best-case dream? And crucially, what's the sponsor's track record? Are they a partner, or do they throw lenders under the bus when things get tough? And, maybe the most important question of all right now is this. Does your manager have a dedicated workout team? Because in this new environment, the most valuable skill isn't finding new deals. It's fixing the broken ones. You need a team with the legal and operational chops to manage a crisis, not just originate loans when times are good. Finally, let's look ahead for a minute. The private credit market isn't going away, not by a long shot. But the winners of this next cycle are going to be the ones who adapt to this new, more challenging environment.
So what's the path forward? Well, the smartest players are already adapting. They're demanding much tougher valuation standards. They're looking for opportunities in less crowded spaces, maybe with more tangible assets. And they're even using new tools like AI to get a clearer, real-time picture of a borrower's health, moving way beyond stale quarterly reports.
Ultimately, if there's one thing you take away from all this, it's that relying on your position in the capital structure is a trap. The only true protection for your capital is the quality of the initial underwriting and the diligence you do after. For all the C-suite execs, high-net-worth individuals, and family offices listening, the message is crystal clear. The time for passive trust is over. It's time to stop believing the marketing myths, dig into the details, and demand absolute, total transparency from your managers. And that leaves us with one last critical question to think about. In the last cycle, it was all about chasing returns. But in the cycle we are entering right now, it's all about resilience. So take a hard look at your portfolio and ask yourself, is your capital truly positioned for what's coming next?